Wasabi wallet. Unfairly private.
Andy Edstrom is a financial advisor and wealth manager. He's also author of the book, Why Buy Bitcoin? Investing Today in the Money of Tomorrow. I had him on and we got to talking about a lot of the crazy monetary policies that we've seen play out, not just this year, but since the financial crisis of 2008, 2009. We also dive into debt culture and how the financial policies and the debt culture that we're living in leads to various outcomes when it comes to individuals, companies, and governments. And then we talk about the trajectory that we're on and how that might play out, as well as how Bitcoin can present itself as an opt-out and an alternative, what a transition to a more hard money system might look like. I really enjoyed this one. I think you guys will too. It's great for previous Bitcoiners and new coiners alike. So if you're new to the space, this will be a good one for you. And yeah, be sure to check it out and let me know what you think in the comments down below. I am Ben with the BTC Sessions, and this is your daily session.
HODL the Bitcoin.
Before we dive in, of course, shout out to sponsors of the show, LEDN.io. This is where you can use your Bitcoin for a variety of different services. Of course, they've got their Bitcoin-backed loans. They've saved me on a few occasions. This is where you can use your Bitcoin as collateral to get a Canadian or US dollar loan. So if you're in a pinch and you need some dollars, but you don't want to sell your Bitcoin because that is a taxable event and you're worried about having to buy back in at a higher price, this could be for you. They also have Bitcoin and USDC savings accounts with interest rates of up to 11.7% annually paid monthly. And they've got their B2X offering using the same loan mechanism to instantly buy more Bitcoin, effectively doubling your Bitcoin on the spot. If you want to check them out, there's a link in the show notes down below. If you click that link and opt to get either of their loan products, they will give you $25 for free into your savings account. Up next, we have the Cobo Vault. This is one of my regularly used hardware wallets, and the reason for that is it is beautifully air-gapped. And what does air-gap mean? It means you never plug the thing into an internet-connected device. Everything is done offline via QR code, meaning you never expose the keys to your money to anything online, keeps them safe and offline for you. This thing has a secure element. It is open source firmware. And by the way, I do recommend switching over to the Bitcoin only firmware option that they have. And it works with all of my favorite wallets. It works with Bitcoin Core, Electrum, Wasabi on desktop, Blue Wallet on mobile, and it works with a whole bunch of different multi-sig solutions too. So be sure to check it out. For reference, I am using the Cobo Vault Pro. It has the fingerprint scanner and the rechargeable battery, which in my opinion was worth it. So check them out. Show notes down below. Up next, I make all of my income, pretty much all of my income in Bitcoin, and I do need to live. So where do I do that? How do I do that? Well, one of the solutions I use on the regular is Bitrefill.com. This allows you to buy basically any gift card you could think of is here. It's insane how much stuff is here. All the good, Amazon, Best Buy, Uber, Walmart, H&M, like everything, Apple, all of it's here. And it's great. So I use this regularly. It's easy to use Bitcoin. It's easy to use Lightning Network. So if you're looking to cut down on transaction fees, Lightning is a breeze to use on this thing. It's incredible. Plus, you're earning sats back. Yes, you're earning Bitcoin back as you shop. I don't know why you wouldn't do that if you're currently living on Bitcoin. Or maybe it's just gone up and you want to treat yourself. Well, earn some of that back in the process. Head to bitrefill.com. Check them out. They do have a ton of other things, phone top-ups, all this kind of stuff. So yeah, check them out. Can't recommend them enough. And then finally, we have privacypros.io. These are the guys that bring you the BillFodl. And what is that? Well, when you're backing up a Bitcoin wallet, you can write down your 12 to 24 words on a piece of paper. Sure, that's fine. At least you have a backup. But that doesn't save you from fire or it doesn't save you from a flood or just accidentally throwing out the paper. So if you want to upgrade your backup, which is advisable, you can put it in solid steel with the BillFodl. Basically, it is a steel plate where you can slide in the little metal tiles that represent your backup phrase, and then you can store it safely, and you can have peace of mind. So if the house burns down or there's a flood, then you're safe. Also, you're much less likely to throw out a piece of solid steel than you are a piece of paper. So check them out, privacypros.io. They've got a whole bunch of other things, hardware wallets, Faraday bags, lots of great stuff there. Can't recommend them enough. And with that, let's dive into the interview. All right, Andy, welcome to the show. Super happy to have you. We've interacted on some other pods and everything, but first time for a one-on-one, so welcome. How are you?
Ben, I'm great, man. I love both the volume and the quality of the content that you are putting out there. As another Bitcoin educator myself, I'm just constantly amazed by the hustle and the quantity and the quality that you're putting out. So I'm really psyched to be on with you.
Thanks, man. It's a bit easier when you quit your job and you just start doing it your full time.
And that's, for me, like this Bitcoin's a side hustle for me, right? Like I really believe in it. I want to educate people, but it's not my full-time job. My, 40, 50 hour a week job is managing people's money. I mean, It would be amazing to be full-time in Bitcoin, and, maybe someday that'll make sense for me.
Yeah, absolutely. We're all hoping. This was a gradual shift over years for me, and I'm lucky that it's panning out so far. But gotta gotta be careful. Gotta not expect too much out of it. So we'll see how it comes, but it's looking decent so far.
Yeah.
I've got your book right here. Why buy Bitcoin?
Love it.
I got it. I got it a while back, actually. I read it. And when did it? When
It
did
was
it come
September. It
out?
came out September of last year. I didn't start shilling it. I didn't start using Twitter
Mhm.
basically until about a year ago, almost exactly a year ago. So it was December last year, when I first sort of started making noise about it. And I did my first pod. That was Bitcoin Echo Chamber with Colin Falstead, I think in
Yeah,
January. Yeah.
awesome. I must have gotten it sometime around the spring, I think, is when I bought it and read it. But
Yeah.
yeah, it's a good dive into, well, exactly as it says, the why. Why should anybody bother to look at and or own this asset? And I mean, if anything, holy hell, this year has given us a reason to dive further into the Bitcoin rabbit hole and to help people see why there might be value here. I mean, it's interesting because we've seen trillions of dollars printed. Um, People, there's massive unemployment that has happened in the wake of everything going on and the lockdowns and so on and so forth. But at the same time, like all-time highs in stock markets, massive rebounds there of hastening wealth gap again. And at the same time, again, small businesses suffering, people out of work, and for the first time, I think, anyways, for the first time, it's been just so blatant, the disconnect between what people are seeing, like in the news of, oh, the economy is bouncing back, and we're seeing all-time highs in the stock market. The disconnect between Wall Street and the day to day of what people are actually living as an income earner. Um, let's Maybe you can talk a little bit about what we saw this year, and I guess how it affected people differently, and why some got richer while other people were massively hurt.
Yeah. So I agree with everything you said, and lots to cover there. I think the story so far of 2020 has been, and this is not my original idea, that it's basically accelerated trends that were already in place. So if software was already eating the world, that trend was already in place when Mark Andreessen wrote it in the New York Times in that op-ed in 2011, almost a decade ago. It's all the more accelerated. the wealth gap, right? The cantillon effect, whatever you want to call it, that was already in place. It's now exacerbated. I think that and then of course, the political divide was already there, and it's, as much in force as ever, and maybe more so. I think when people, especially normies and or legacy finance people, talk about 2020 and they talk about how they found Bitcoin, right? For those who are finding Bitcoin in 2020, they'll say that, oh, the pandemic changed everything, right? Like that was the catalyst for them, and it just brought into stark relief the scale of the government deficits, the scale of the money printing, the scale of the of the rot in the system. And I will counter that actually, when I published my book a year ago before the pandemic, every single one of those trends was already in place, right?
Yeah.
And so the debt was already unrecoverable, right? There was too much debt as a percent of GDP, as a percent of the economy, both in this country and across the world. And then you added on the unfunded entitlements, right? The Social Security and the Medicare and all that stuff, all the pensions, what they call in Europe, quote unquote, pensions, we call them.
And that doesn't count towards the debt, does it?
Well, right, exactly. And the figures in the book, remember, I think debt to GDP I had in the book was around 350% total debt to GDP. Okay. That's household, corporate, government total in the US. And actually the figure globally is comparable. And then the entitlements, the unfunded entitlements, are another 1,000% of GDP, right? Okay. So you add them up and you've got 1,400% of GDP or something like that. And so, of course, now we printed a few more $1 trillion. I say we, I mean the Federal Reserve, other global central banks, printed a couple trillion more, and now the deficits are even bigger and the debt is even greater. So for sure, it's been an accelerant to the reaching of the end game, which I wrote about in the book. I think that end game is basically inflating away the debt. I don't want to spoil. I don't know if you. I don't want to spoil a future guest you've got coming on. I'll leave it to you, to mention his name, an episode that recorded. But he takes a deflationary view. That's maybe my only point of disagreement with him about sort of how this plays out. But yeah, I think these everything that was already in place has just been accelerated, and it's finally gotten to the level where probably the average guy on the street, at least some percentage of the average people on the street, are saying, oh, how much money can they really print? Like what is the limit, and what does it mean to print $1 trillion or $2 trillion? And why, when I go to the supermarket, does the steak that used to cost me $15 cost $25? And why are certain goods in short supply? I'm talking about in the cities, like where I live, and what's going on here.
So let's talk a little bit about impacts on individuals that these types of government and central bank actions have. So we keep hearing, at least in, you're in the US, I'm in Canada, we keep hearing that they're not hitting their inflation targets. They're not hitting, that 2% that they're striving for. And they have something called the CPI, or the Consumer Price Index, which tracks inflation. And they say, well, we're not seeing what we need from inflation. In fact, Stats Canada released a report like a month or two back. They said, well, inflation's only been 0.5% for the last number of years. What's the disconnect here? Why are people feeling that pinch, having their expenses apparently seem to go up and having a harder time keeping up, but the government is saying that's not the case and we need to ramp up inflation more?
Yeah, a lot there. So the first is, what do the statistics actually measure? You mentioned CPI. I agree with you. CPI is the sort of canonical thing that people talk about. The Fed claims that their primary measure is a different measure called the PCE, the Personal Consumption Expenditure Index. It's similar. It's a little different than CPI. It's different in how it's calculated and what the weightings of the various components are, but it's in the same vein. one of the things I wrote about in the book was how these things are constructed. The most blatant problem with these indices, I would say, is housing cost, right? So housing costs is like 42%, okay, of the CPI. It's by far the biggest component, which makes sense when you think about it. But and I can't remember, I think it was back in the 80s, they changed the way they calculated housing costs, right? And what they did is they used to use actual rents, but then they changed the methodology. I can't remember the name of it. It's like imputed rent. But the concept is for homeowners who own their houses, they make this calculation of what your rent would be, if you were renting the house, even though you're not. Mm-hmm. And the problem with that statistic is rents haven't been rising especially fast because interest rates have been coming down, right? So when you look at the market overall and you say, okay, what determines rent? Well, it has to do with the capital cost of owning the property. If you're an investor, right, you own an apartment building or you own houses that you're renting to people, you say, oh, okay, what are my costs to own this asset? Well, there's maintenance, obviously, capital expenditure to keep the property up, and there's tax. But the biggest component, of course, is the mortgage, right? Because real estate is by far the most levered asset class, right? There's more debt against real estate by far than any other major asset class. So if you keep lowering interest rates, well, the mortgage payment goes down. So yeah, rents have been kept in check unless you want to actually own your home, right? Because the outcome of this is that interest rates go down, property prices go up, house prices go up. They're going bananas in my neighborhood. Young people, younger generations are just getting completely priced out of the market. So, have rents stayed low? Kind of, but at the same time, you've inflated this bubble of property prices and effectively priced younger people out of the option to own a home. So again, 40% of the CPI, right, is housing costs. So that's artificially held down, and you have this negative effect on purchase price of houses. And then there's numerous other problems. It's unclear sort of how to track and measure, what the cost of something in the goods basket is when, the old type of computer gets replaced by the new type of computer, or the desktop gets replaced by the handheld, by the mobile device. And then of course you've got a lot of the indices sort of strip out volatile, quote unquote, volatile things like, food and energy, also known as the things we actually consume.
Yeah, who needs those every day?
Yeah, exactly. And so
anybody.
It's just ridiculous. And the honest truth about inflation is devilishly hard to actually measure. I mean, you'll never, no supercomputer or team of brilliant scientists is ever going to put a reasonably tight box around, what is the actual inflation? This is not a physics problem. It's extremely hard to measure. And then of course you got the last issue, which is, the entitlements that we were talking about before, those are indexed, right, to the inflation levels. So what is the government's incentive to in terms of how they're going to calculate this thing that raises or lowers their future liability? Well, the incentive is to understate inflation. So, for all these reasons, yeah, I think the inflation numbers are they're flawed and biased, and I don't want to say useless, but they're not that useful.
Yeah. So from a regular kind of wage earning perspective, people as we've been talking about are feeling disenfranchised. They're not quite sure where to funnel their anger. You see regular day-to-day people effectively looking at corporations and big companies, things like that, and pointing the finger there and saying things like "eat the rich" and "down with capitalism." And you see a lot of that sentiment nowadays. And part of it may be a misunderstanding of what's happening and why that wealth gap is widening. Talk a little bit about how when you have these influxes of capital, central banks injecting capital into various places, how does that drive this wealth gap? Where does that money flow to that benefits some, but not others.
Yeah. So a few pieces there. So the first is just the obvious working capital concept, which is if you are an average or poor household, right, your first dollars of wealth, quote unquote dollars of wealth, are held in dollars, or Canadian dollars or whatever your currency is, right? If you are barely scraping by, you have to have enough cash in your checking account to manage your life, pay your bills, pay your rent, etc. There's no surplus, basically, right? So all of your sort of assets, quote unquote, meager as they may be, are in cash, and cash is constantly depreciating, right? There is some inflation. They are printing more of it, so the purchasing power is reducing over time. So if you're poor, 100% of your net worth, right, is getting depreciated away. In contrast, if you are wealthy, you keep that minimum amount of working capital, but the other, whatever, 90% of your assets or 95% of your assets, you invest elsewhere, often in cash flowing assets. So you're protected against that inflation problem. So as a percent of net worth, the poor are effectively taxed at a higher rate than the rich when it comes to monetary policy and inflation. So it's therefore a regressive tax. So that's one. Second one is obviously, the QE, right? The printing money by the central bank to buy bonds. What does that do? That buys bonds. The basic math on buying bonds is price of bonds goes up, yield comes down. And the yield of government bonds is the benchmark against which substantially all investment assets are measured. So when the 10-year treasury was yielding 5%, well, then maybe you demanded a 10% annual return on stocks overall because there's more risk. But when the 10 years at 2%, now maybe you're going to only demand 7% annualized return on stocks. And when the demanded return comes down, that is reflected in the price going up. So this is what we see in housing, right? Where prices have gone bananas. That's what we see in the stock market. It's what we see in most risk assets. Well, who does that value accrue to? Well, it accrues to whoever owns those assets, and that's the rich, right? The average American doesn't have a significant stock portfolio. I think the example I used in my book was, ask your cleaning lady how her stocks are doing, right? These people don't have those assets, so they don't get that benefit. That accrues to the rich. And then the last thing is sort of the direct cantillon effects or cantillon effects, which is literally when the money gets printed and the bonds get bought, they get bought out of the inventory of the banks. They get bought, out of the inventory of hedge funds and investment funds. So the dollars first go, mainly to the banks, which goes into the pockets of the bank employees, as well as the shareholders of the banks. Now, eventually, after some time lag, the quote unquote new money gets lent to corporates. So that goes into the pockets of the CEOs. And then finally, hopefully, it goes into the wages, of the workers, but they're the last on the ladder. And that's the common misconception. They teach you in economics 101, in econ 101 that, they print more money, like, prices just rise all at the same time. No, there's a series of events, and being closer to the spigot makes you richer sooner, or allows you to buy goods and services before the prices have increased and sort of flowed through the whole system.
Yeah. Okay. So we saw a lot of that in response to the recession in 2008, 2009. We saw a lot of the QE where it's direct into more or less the banks, and there's share buybacks, all that kind of stuff. We saw a little bit different this time around. We saw checks mailed out to individuals. Now, I'm hoping maybe you can speak a little bit to what the effects of this may be, especially in a situation where, because we've seen lots of calls for UBI or universal basic income, where people just get like a set amount of money every month to survive, what some of the second and third order effects of that may be. But also, perhaps we could dive a little bit down the rabbit hole of what percentage of money, and even if you don't have a specific number, how much of the money being created is actually going to regular citizens versus percentage going to, again, the higher ups, and how does that perhaps disenfranchise even the people that are getting free money and feeling richer temporarily.
Yeah.
What does that look like?
Yeah. So there's a lot there.
Yes.
First on the checks in the mail, it's about time, relative to what government policy has been, right? It's all been flowing to the rich and those owning assets. So in terms of, evening up the score has been extremely uneven for a long time. And
Yeah.
this maybe caught it up a little bit.
Yeah.
Now, with respect to inflation, generally what I think most people would say is the marginal propensity to consume by, a poor person is much greater than that of a rich person. You give the rich guy or even the middle class guy another $1,000, he doesn't run out and, go out to dinner, 3 more times or 4 more times, or buy a bunch more stuff. No, his marginal dollar just goes into savings. He goes and invests it. Whereas the average person, especially someone who may have lost their job in the pandemic, is going to spend that money. So that actually flows in large part back into the economy. All else equal, that tends to be inflationary. Now, putting money in people's pockets, like I said, is better, I would argue, for society than, just fueling the assets of the rich. Okay. With respect to, the balance and the fairness and who got paid, I was shocked and dismayed, and I wrote about this, when the CARES Act was passed and the bailout, the latest and greatest bailout, came out in whenever it was, March and April, because so much of it flowed to corporates and so much of it flowed to companies. And I remember having this debate. I can't remember who it was. It was, I think, with a family member, and I was like yelling at him, and I was like, companies are not people. People are people. People are the people are the people that need the money. Companies are not the people that need the money. And most of it flowed to corporates, as well as just the outright, asset purchases, which flowed to investment portfolios. Thank you, Federal Reserve, for saving, my clients' portfolios. I benefit from this, more or less directly. But yeah, the split in terms of corporates versus people was not. I don't remember the numbers off the top of my head, but it was really not very. It was not fair, not equitable, not favorable. And the logic, that was employed was, it's harder to find the people directly and deliver that money versus giving it to the companies to distribute on the people's behalf. But it's interesting, like luxury vehicle and boat sales. Boat sales are my favorite. Boat sales rocketed, in like May, June, because it was probably, my guess, not small, but more like medium-sized business owners who got these checks, and some of that flowed to their employees, and some of it went to the pockets of the people managing the companies, and they had more money to play around with. So that's my perspective on it, and I think that the public, I hope the public is figuring out what's going on. I think it is probably indicative of why we haven't had yet another stimulus bill passed. Is maybe people are wising up to, the distribution of the stuff was let's say suboptimal, and I'm I hope, I know there's going to be more stimulus, and given that, I just hope more of it goes directly to people who need it rather than companies and capitalists. But I'm not that optimistic that that's how it'll go. We'll see.
Yeah, fair enough. Now down the same line, I want to maybe get into a conversation about debt culture and perhaps how that affects again a little bit of everybody, I guess, when it comes to individuals, when it comes to even government debt, and what levels those have risen to, over the past 10, 12, 20, I mean, number of decades, however far you want to go back. But what do you see this kind of culture of debt? Where does it come from, and how quickly is it growing?
Yeah. So it's growing exponentially. And that's not surprising when you know, realize that the money isn't tethered to hard money because it's just fiat money. So the banks can print more. So they do every time there's a recession, and then they're supposed to take away the punch bowl, you know, when you get the recovery, but they never quite do it. So it's this sine wave, you know, of money supply and stimulus through the business cycle, except it's sloped, right? It's
Mhm.
upward sloping. And the, you know, the culture of money and debt, because in part because the cycles are so long, right? The long-term debt cycle lasts typically 80 years, right? The last one started, you know, basically post World War II with the Bretton Woods system, and then really got going when we left the gold standard in 1971. And when you live a lifetime where you look around and you see that people that borrow make money because they borrow to invest in assets and the prices go up, and then the interest rates go down, so the cost of that debt decreases. I mean, just imagine. I'll give you a specific example, right? And this is something I talk with, you know, about with my clients, and I'll get some flack for this, but most Americans still borrow to buy homes based on a 30-year fixed rate mortgage, right? And the 30-year fixed rate mortgage now is like, it's almost down to 3%. I mean,
Mhm.
it had been, you know, back in the 80s, it was well into the double digits. But the advice I give my clients, or have been giving my clients since I did the research for the book, like since it became clear to me that there's no way we can pay off the debt, it has to be inflated away. The advice I give is like, look, why would you pay for the rate protection, right? Because there are
Mhm.
other structures in the mortgage market. You can do a 5-year arm, a 7-year arm, a 10-year arm. Stands for adjustable rate mortgage, and that's still a 30-year maturity mortgage, but you only have a fixed rate, you know, low fixed rate for 5 or 7 or 10 years, and then it floats afterward. You know, you can save significant cash out of pocket today by doing the arm structure. Me personally, you know, I've lived in a house that I've owned for 8 years. And in that period, I think I've refinanced. I think I've done like 8 mortgage deals. Okay. Because they keep lowering interest rates. I never do a 30-year fixed rate, right? I do a 5-year arm or a 7-year arm to minimize my cash costs. I never pay fees or expenses. I say, look, if you want to make my rate slightly higher, right, so that I don't have to pay you anything out of pocket, that's what I do, because I know I'm just going to be refinancing again in another year.
Yeah.
And you know, it's so people pay for the rate protection, but it's sort of silly because if rates normalize, it's just going to be a depression. And so the government's, you know, just not going to allow that. I mean, there's the rate risk, and others smarter than me figured this out, you know, years ago. It took me until, you know, the last couple of years to really figure this out. But yeah, the rate risk embedded in these things is so minimal that I think it was Trump. I think it was Trump that, you know, said on record, like, you know, only idiots don't borrow money, right? Like, you'd have to be dumb, you know, not to lever up as much as possible, because the burden of that debt just goes down and down and down as interest rates go down and down and down. So yeah, that permeates everything. I mean, it reduces the propensity to save. It causes people to borrow in order to speculate on assets, which, you know, leads to probably huge misallocation of capital. It means, you know, companies that shouldn't get funded do get funded. Companies that should die or should have died earlier, you know, get to limp along. The zombie
Yeah.
companies, as they say. You know, how many zombie companies came out of the recent efforts by the Federal Reserve to literally outright, you know, buy corporate debt and prop up these over indebted companies? So
Well,
yeah,
I, I was I was gonna say like that directly affects. You know, people will point and say, well, you know, it's too big to fail. It'll cause too many jobs to disappear and so forth. But that, in effect, in propping up these zombie companies, these companies that should have died, um, that has a longer term effect on society as a whole and how we progress. No.
Yeah, I think it does. I mean, the best and leanest and meanest, you know, entrepreneurs, the scrappiest, the most likely to be successful, they would ordinarily compete with and destroy companies that are propped up, by cheap money. And there's also a differential here between, the bond market, let's say, and everything else, which is to say, once you reach a certain scale as a company, right? Whether this is because you've achieved, a monopoly position or not, we can talk about that. Your funding cost is extremely low. But the funding costs for, startups and smaller companies is actually substantially higher. It's interesting to observe this issue, which is that when you look at the stock market in the US over the last decade, right? Substantially all or most of the return has come from already big companies getting bigger. Small cap stocks have performed pitifully. Historically, when you look back at a century of data, which is something that, asset allocators like me do on a regular basis, small cap stocks usually outperform over long periods of time. And that makes sense. I mean, it stands to reason because, smaller company, more likely to fail. So as an investor, I'm going to demand some return premium. And over time, if I take that extra risk, I get rewarded for it. Not in the last decade. And the issue started to appear even in the prior decade as well. So yeah, there's capital misallocation. There's basically shoring up and supporting and propping up already sizable organizations at the expense of smaller competitors who, in general tend to be more innovative. They also tend to create more jobs as well. That's a whole other issue rather than the large companies. And yeah, that I think is a major effect. It's probably a major retardant on overall economic growth. And it also, by the way, increases the wealth concentration in itself, right? Because if you're a founder CEO of an already large company, you're already very wealthy. And so more accumulates to you. We see this with the internet giants, where the founders are literally worth tens of billions, in some cases, over $100 billion. That concentrates wealth further. So a lot of factors there.
So and in part almost like unjustifiably so, because if the reason that you're succeeding is because you're being propped up and not I guess thrown to the wolves as the smaller startup companies are, then you have this unfair advantage, which means that potential ones that would have swept in and been able to do things more efficiently, offered better products for cheaper prices to individuals, never get that chance and just are killed. And meanwhile, you're doing things that not in all cases, but in many cases, you were going to fail, perhaps because you were not able to efficiently bring your product to market. And now you're in this spot that you can't be dethroned because you're too big to fail. They're stringing you along, and people are left with a more expensive product that is not as good.
100% agree with you. You end up with less job creation. You end up, as you say, with worse and more expensive products. And we'll never know the counterfactual, right? We'll never know historically how much economic growth we might have had if we hadn't had this terrible fiat system. Credit to Saifedean. He does a pretty good analysis in his book about the late 19th century when we did have hard money and when overall economic growth was substantially higher than it was today. So that is, I think, a relatively compelling argument. It's not apples to apples because it's a different time period, right? It's a different piece on the time series. But nevertheless, yeah, I think that, and this is why, guys like Brady Swenson, talk about the Bitcoin Renaissance. Imagine how much more prosperity we could have if we had a hard money standard, especially if that hard money was Bitcoin.
Yeah. Yeah, 100%. It's interesting to see the current sentiment across the majority of kind of regular day-to-day people that are effectively cheering on this government intervention when in the end it's furthering again that wealth gap and funneling money into the very corporations that they're already angry at, because capitalism, when what you're seeing is the opposite of capitalism, it's reallocating wealth away from people more or less to corporations that are no longer really competing. So
Absolutely.
yeah.
And
Yeah.
there's a couple, just to underscore this, there's a couple, components of government policy there, right? One is the literally, funding of the zombies. That
Mhm.
clearly
Yeah.
is a big problem, and it drives what we're talking about. And the second thing is basically is antitrust and monopoly policy. And this is one thing, the thing about capitalism, unfettered free market, just totally laissez-faire is, and there's a lot of proponents, especially in the Bitcoin space, that just say, look, just let everything rip, whatever happens, happen.
Mhm.
And the problem with that, at least historically, is that there are companies that can achieve market power. They consolidate horizontally, especially, such that they've, a single or a couple companies basically, are the sole providers of, a particular goods or service, and they end up with pricing power. And yeah, and then the consumer gets shafted. That is going on for sure in America now. The antitrust, effort department, the Justice Department, has basically been asleep at the switch for 20 years. It's reached levels in terms of industry concentration that are comparable with a century ago, right? The Gilded Age. And so that's another, major issue in my opinion. Now, the true free marketers would say, well, if you also removed the lobbying effort, and you removed basically the regulation that allows companies to capture their markets because they impose this higher, regulatory compliance costs on their smaller
Mhm.
competitors, right? Because the big guys can afford to pay,
Yeah.
X millions of dollars basically to comply with rules. The free marketers say, well, if you remove that, then you'd still have competition. I am open to that possibility. I don't know if we've ever seen it actually in history,
Yeah.
but I think it's important to at least acknowledge that in the world that we live in today, where there is a government, and therefore there is a government that can be captured by large companies, you probably are going to need some kind of antitrust effort in order to prevent companies from acquiring their way, to dominant market positions and monopoly pricing power, that they can turn the screws on the public with. So that's the
Yeah.
other piece that I think's important.
So with all this talk of everything that's going on in terms of again the heart that people are feeling, the inequity across the board, the rampant money printing, what's the end game here? Where do you see this going? Not it in a well, I don't know. What do you think our trajectory is in terms of the status quo and the way things are currently going?
Yeah. So I guess I'll start with the financial picture, right? Which is like, how can this debt problem resolve? And the good news, credit to Ray Dalio, who hasn't yet figured out Bitcoin, but I'm sure he will.
It's working on it.
He's written a lot of good content on the long-term debt cycle, and this is a known, documented historical fact. Uh, People don't seem to know about it, but you get these long cycles of debt accumulation, and they resolve themselves. And they resolve themselves in a few possible ways, right? I've got a short chapter in the book about the 6 options, right? The menu, the menu of bad options for dealing with too much debt. So the first is austerity, right? That's belt tightening, living within your means. Basically politically impossible, because when you got politicians elected on 2 and 4 and 6 year cycles, the ones that can deliver more goods than they take in tax revenue get reelected. So you got perpetual deficit spending. So good luck with austerity. You can have mass defaults. That's what the Depression involved. And because we had the Depression, and because people know about it and how terrible it was, it's unlikely that the government's going to go in that direction. You can have a jubilee, right? What was called in biblical times a jubilee, debt forgiveness. Now, people today are using that term to describe basically government, printing more dollars or in order effectively to forgive debts like college debt. That's a different concept than, a true jubilee, which is literally declaring debts null and void. That used to happen in ancient times, but it's problematic because one man's debt is another man's asset, and that's hugely deflationary. It causes economic activity to contract. Again, you can end up in a depression. So more likely, I think, are the items on the bottom of the menu. One is tax and spend redistribution. I don't know if we'll see that in this administration or the next, but let's just say that I'm expecting more soaking of the rich and more checks, basically to the poor and the middle class. Another option basically is ongoing. That's financial repression, right? This is a term coined by a couple of Stanford economists in the 70s. It's basically keeping interest rates really low, punishing savers. Ultimately, it can result in capital controls. I could see that happening. We're not there yet, but I could see it happening this decade. And then ultimately, the most popular escape valve, if you are the issuer of the world reserve currency, or at least you're the issue of your own currency that's used in your country, that option is inflation. And I personally think that's where we're headed in this decade. So there's too much debt. We're finally going to reach the resolution. I think it's going to happen this decade. It may even happen in the next 5 years. Timing is always difficult to call. My colleagues often point to Japan and they say, "Oh, look, Andy, they have way more debt in Japan, and that house of cards hasn't come down yet." And that's true. Japan is a special case, because it's such a unified and homogenous society. They all pull in the same direction. Plus, they have significant net assets, basically huge piles of assets they've accumulated abroad, to help offset the debt. But it's also the issue of, people look at Japan, they say, well, until Japan collapses, nothing else will. And the problem with that logic is, well, eventually that, debt situation in Japan probably will collapse. Let's say it's at 450% of GDP, debt to GDP. I'm making up a number. Well, when that goes, people aren't going to be like, oh, 450%, that's the number we can get to before our system goes down. No, that's the panic moment that triggers people to think about, oh, well, if it happens at 450, could it happen at 400 or 375 or 350? So yeah, it's one thing, you never know where the tipping point is in advance. Let's just put it that way. The other thing that I think is that we're halfway through the fourth turning, right? This is, this is Neil Howe and William Strauss's excellent book from, I think, 22 years ago. They, by the way, called that right around now or slightly sooner, there would be some triggering event basically that would basically cause the fourth turning and cause a crisis, substantial crisis, like 80-year cycle crisis. And I think there were 5 scenarios they put in their book. Maybe it was, I think it was 5. And one of them was a pandemic. That was 22 years ago. So interesting. I think that we're getting to the stage where our institutions are not functioning properly. And usually the way that goes in the last few cycles is war. I'm still cautiously optimistic that it won't go that way, but I can also construct scenarios, 2 obvious ones, right? One is the external threat is the rising power of China, and you get in this Thucydides trap conflict like happened with Athens and Sparta, millennia ago, and has happened many times since. That's the external conflict. The internal conflict is, equally possible, maybe more so, is just the, widening gulf between the red team and the blue team that ultimately results in, violence, some kind of civil war, secession. I don't know. So I actually really am worried about these factors for this decade. I'm really optimistic about the longer term because the way this usually goes is you get through this conflict, stronger institutions, new, stronger institutions are forged. Bitcoin may be one of those institutions. I hope it is. And it strengthens society. It strengthens individuals. And then you've got hard times creating strong men again. And then, things go well for a significant period of time. So yeah, I'm sort of pessimistic for this decade, optimistic for the longer term. I think there's going to be bigger more major conflicts than we've seen. There are, potential outs in theory, right? Like, could we turn the ship? And what could turn the ship? In theory, if technology is accelerating like exponentially, there could be so much economic surplus created, right, that it can actually, support and deleverage the whole debt edifice. But that depends on, one, it happening fast enough, and two, like the distribution of that wealth creation, right, being percolated out. So you kind of have to get two hard things right in order to get out of this debt mess, basically by just growing out of it. Probability of that happening soon enough, I think it's low, but who knows? Maybe.
Yeah. So obviously, a lot of people in our neck of the woods are, they've seen and learned about Bitcoin, and obviously basis for your book. Why does Bitcoin present such a compelling out of the current economic system, and what do you see in it, and what does that transition look like if it's successful?
Yeah. Wow. Okay.
I
I'm
mean,
going to try to give a short answer.
Yeah, you can give a Cliff's
So,
Note version of it.
yeah, exactly. So when I pitch it today, I keep it really simple. Digital gold, right? Hard money. That's it. People, I think, can understand that. And it's super simple. And in a world of money printer go, brrr, people get that. What I write about in the book is much more, substantial. It's not only does it take share from gold, but it takes share from fiat. It takes share from offshore assets. It also is this new enabler of amazing new applications that weren't possible before, whether it's micropayments using Lightning, which actually seems to have some traction now, I think, which is awesome, or it's, collateralizing many kinds of assets, using Bitcoin, all this stuff. That's all upside, and that's great. And I have huge hopes for that. That's the 100 trillion, multi-$100 trillion upside case in today's dollars, right? Not just, funny money inflated away dollars.
Yeah.
But I keep it really simple these days, and I focus on digital gold. So it's, to me, like, I get frustrated sometimes. Like, it's so blindingly obvious that one must own inflation-proof money.
Yes.
And yet people are still struggling with it. I think they're still struggling with, the idea of prohibition. And I see that possibility as so remote, so low probability at this stage. And even if it were going to happen, we're nowhere near that in terms of price, right? It's like, okay, talk to me about prohibition at 100K Bitcoin, maybe.
Yeah.
So, it's like, it's the inflation-proof asset that you must own. And then in addition to that, when you're just looking around and seeing, oh, how much do I trust my government? How much sort of functionality do I see there? Oh, what's this, government issued cryptocurrency? They're doing that in China, which is a surveillance state. Are they going to do it here in the US? I'm already basically fully or substantially fully surveilled, if I'm not taking precautions when I use the internet on a regular basis. Now, are they going to have full surveillance of my money? All these things, all these things are things that I talk about and point to, and that I think are in people's heads. I am quite optimistic that a hard money standard will mitigate or reduce the theft through inflation that hits the poor hardest. So it is actually progressive, right? It's progressive there. I am optimistic. This is a debate I've had with a couple of clients. It's the boil the oceans debate, right? Is it pro, or is it positive or negative for the environment? I actually think it's net positive. I do think it accelerates the development of renewable energies by unlocking stranded assets, which increases the units installed of solar and wind and hydro, which funds the R&D budgets of these companies, which brings down the unit cost, which makes it more competitive with the old, the legacy fossil fuel systems. It's an accelerant, I think Jack Dorsey, I think I saw a tweet. I think he tweeted or made a statement in the last day or two, talking specifically about how his expectation is that in the long run, Bitcoin will run 100% on renewables, and that Bitcoin will accelerate the development of the renewable sector. That's crucial. So I don't know. I'm going off on a couple of tangents here for you, but yeah, I think that Bitcoin wins by being the obvious hard money, by being harder than gold, by capturing market share from gold, by getting into more people's pockets, by watching the number go up, by causing people to learn about it, whether they're reading my book or whether they're watching all the great content that you put out. You get the feedback loops. You may have another boom and bust cycle, but this time around, man, there's going to be a lot of people learning about it. And I think it just continues to get entrenched, continues to win, continues to attract more talent. This is the cycle, I think, where legacy finance guys are really going to pile in, right?
Yeah.
It's not happening right now, but 12 months from now, when potentially we're past $1 trillion in market cap, just for Bitcoin, and who knows, maybe with the whole sector, it's a couple trillion with all the other alts, et cetera. We'll see. And so yeah, this is going to be attracting a lot of attention, and people are going to learn about it. They're going to realize why it's important and useful, and the feedback loops, and to the moon, man.
Yeah, and again, like you said, that it's not there yet, but we're seeing the writing on the wall. There's a lot of legendary Wall Street guys that already know that they don't want to hold dollars. They know that they need to get their dollars into other assets to maintain kind of their wealth, and they're waking up to Bitcoin. We're seeing it in headlines every day. It's all over CNBC, Bloomberg, all kinds of people jumping in. And so I think that you're right that there's going to be this wave of smart money, and hopefully some people watching this will be able to front run some of those guys.
I really hope so, Ben. I mean, this is the thing that seems to be different about this cycle is, it's always said that this was a retail-led phenomenon, and that's true, right? A lot of people, just average people, have had a chance to get a bite at this apple, right? This may be the last chance, really, because when the corporates come in, when Saylor buys tens of thousands of Bitcoins and continues to buy, right, just comes over the top and buys more and borrows to buy more, et cetera. It seems like it's only a matter of time before this really gets bought up by the already rich and the corporates, which will further entrench it and sort of remove, the remaining risk of prohibition or, of really negative government treatment. But yeah, this is why I've been, banging on the heads of my friends and my family for the last few years.
This is why there's a big title in your face right now on this book. Right. Why buy Bitcoin? This is why.
Exactly. And, I kind of hope that it crashes again and people have a little more time to stack, but I don't know. This may be the last shot.
Yeah, I kind of feel like March was the opportunity of a lifetime, that we're likely not going to see something similar to that, maybe ever again. I don't know. Yeah. But Andy, I want to say I had a blast chatting with you. It's always wonderful having you on the well, I haven't had you on the show, but being on a show with you. And I'm glad that I could finally get one-on-one with you. So thank you so much for coming on. Can you let people know where they can find you, whether it be Twitter, website, book, whatever?
Yeah, of course. The usual shills. So Twitter, Edstrom Andrew. Personal website, andyedstrom.com. Obviously, the book is Why Buy Bitcoin, mostly sold through Amazon, but it's also on Apple and other channels. And of course, I'm affiliated with swanbitcoin.com/Andy. And look, I really enjoyed this. I love what you're doing in the space. It's been a real pleasure talking with you, and hope we get to do it again sometime.
Awesome. Thanks so much, man. Thank you guys so much for watching and or listening. If you are on YouTube, please do hit like, subscribe, and share. All of those things help so much. I can't stress it enough. Every time you do that, it bumps videos like this in front of more eyeballs. So thank you for those of you that are doing that. If you want to help out the show in another way, you can hit up the sponsors I mentioned previously down below. That was LEDN, Cobo, Bitrefill, and Privacy Pros, aka the guys that make BillFodl. And if you really liked what you saw, you can always drop me a Lightning Network tip at my tippin.me page. That is tippin.me/@BTC Sessions. With that, I am out. Have yourselves a wonderful day or a wonderful evening wherever you are, and I'll see you next time for your daily session.
Hodl the Bitcoin.